All right, what's going on, y'all? Today I'm gonna help y'all understand the stock markets with key terms and common lingo. What I'm gonna do is I'm gonna have a little series where I go over certain things in depth. So, like strike price, for example, chart patterns, support and resistance, and so on, to help y'all become great, profitable traders. So, to start out, we got stocks. A stock represents a share of ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. So an example of some stocks, of course, is like Apple, Google, Tesla, Meta, and so on. You can buy into those and basically own a piece of it. Then we have shares. A share in stocks is a single unit of ownership in a company. When you buy a share, you own a slice of that company. So, for example, we have Apple. If Apple's total shares was 1,000 and you bought 10 shares of it, you'd be owning 1% of Apple. Now we have bullish and bearish. Bullish and bearish is just telling you basically the direction of the market. So if I say the market's looking very bullish, that means the market looks like it's going to go up. If I say it's looking bearish, that means it's looking like it's going to go down. A great way to remember this is bulls strike up and bears strike down if they were in a fight. So here's an example of a chart that's looking very bullish. You see how it's just going up and up and up. Although you do have some times where it's going down, the overall structure of this chart is very bullish. Right here, you could say it's more of a bear structure. So remember, bears strike down and bulls strike up. Next, we have key stock market terms. We have trade. Trade is when you buy or sell a stock. So if I bought Amazon shares, I'd be trading Amazon. Now, with trading, you have different styles of trading. So we have day trading, which is buying and selling the stock within that same day. So when you get into options contracts, you can buy those option contracts that day. And if you want, you can end up selling them later on that day. And that's a day trade. Same thing with a swing trade. You buy those option contracts, you swing them overnight or maybe for a week, and then you end up selling them. Now you completed a swing trade. Next, we have long and short. You can compare long and short to bullish and bearish. So if you're long on something, you're going to be bullish on that stock, which remember, bulls strike up and bears strike down. So long, you're bullish on it, so you're betting for it to go up. Short, you're bearish on it, so you're looking for it to go down. And that's the same thing with calls and puts. So call is an option trade that's betting on the stock to go up. So if I have a call on Amazon, I'm betting for Amazon to go up in my option contracts. Same thing for puts. If I have puts on Amazon on that option contract, I'm betting for it to go down. So you can group long, bullish, and calls together, and then you can group short, puts, and bearish together. We already talked about shares, and this definition is just breaking down that shares have no expiration date. So there are expirations on contracts, which we'll get a deeper dive into options trading and contracts in the future, but shares have no expiration. So basically, when you invest in shares, you're just most people invest shares for long-term things. So years and years out from now. So like for example, Amazon. Amazon is a stock that's going to keep going up. Apple is a stock that's going to keep going up. Meta is a stock that's going to keep going up. So in those is where you invest shares and then you're using that as like another high yield bank account basically. Now we have volume. Volume is the number of shares of a stock traded during a particular time period, normally measured in average daily trading volume. So volume is important when it comes to day trading, because if you have no volume, the contracts aren't going to move, the whole chart's going to be choppy, and you're not going to be able to make good money from a low volume trading day. Uh, so there's something called momentum trading, and that's when you're trading off high volume and momentum, and you're able to make some pretty good profits from just that volume coming in. So next we got common lingo used. You have scalp trading. Scalping is very quick trades. You're kind of in and out of trades in a couple of minutes. I personally scalp. It's very intense, and you have to watch the charts, and you have to get in and out when you're doing scalp trading. Then we have swing trading, which we already talked about. That's holding stocks for more than one day, and selling maybe the next day or a week out. Then we have take profits. So taking profits is selling your position. Now, you're not always taking profits. Sometimes you're losing profits or you're losing your funds. But if you're up on your stock and you TP, that's taking profits. Next, we have buying power. Buying power is how much money you have left to spend on stocks. So if you load an account up with $500, you can only use that $500 of either buying shares, option contracts, or whatever it is. If you're day trading on a cash account, you can only spend whatever you have in your account for that day. So if I have $2,000 in my account, I can only trade that $2,000 until the next day when my funds settle again. Then you have hold. Hold is just holding the stock for longer. So if you think the stock's gonna go up, um, a day later, you can hold those contracts and wait for that stock to go up. Next, we have gap. Gap is an empty space where there is no contracts or shares being traded. Um, so with gap, you have gap up and you have gap down, and I'll show you guys some examples of a stock gapping up and gapping down, and just the gap in general. All right, guys. So this is an example of gap up. So you can see where this arrow is. We have nothing in between. You can see here we have things in between. These candles are pretty close. We have wicks, and then the next candle appears. But right here we just have a big gap. So this goes into one of our other key terms, which is the earnings report. So every company has quarterly earning reports. Um, so PLTR had their earnings report, which was positive. They made more than what was expected or what was estimated. Um, so that made the stock become very bullish and it gapped up from where it was previously. So that's an example of gap up. And I'll show you guys, see if I can find an example of gap down. All right, so right here, you can see whenever the pre-market opened, we had a big gap down from 142.20 about to 141, we'll say 50. And so that's an example of gap down. And like I said, as we go on in the future, I'll make more in-depth videos about kind of everything that we're talking about. I just want to get you guys familiar with the lingo that's being used. That way we can begin our trading journey together. So we covered earnings report. Like I said, that's just annual thing that companies have. It comes out, kind of shows their finances, how much they made, how much they spent, and so on and so on. Then we have high a day and low of day. So high a day is the highest price of the day, and then we have low a day, which is the lowest price of the day. So I'll show you guys an example of that as well. And in the future, I'll continue making videos of more in-depth breakdowns of things that we have. So for example, I'll make a breakdown of scalp trading and swing trading, strike price whenever we get to it, and so on. So we talked about earnings report. Like I said, that's just an annual report or quarterly of a company, of their finances. So it could be how much they made, how much they spent, their net profit, and so on. Then we have high a day and we have low a day. High a day is the highest price of the day, and low a day is the lowest price of the day. So with these two, you can kind of use this in a trading strategy. Some people profit a lot of money just off the high a day and low a day. But when it comes to trading, you can't just use one piece of information and go with it. You have to use other things that correspond with it. So, like I said, high a day and low a day can be strong indicators of a trade. So, for example, on this PLTR chart, um, once the market opened, it jumped up here instantly in one candle. And then a few candles later, it made this high day. Now, A few more candles later, we tested this high a day, and the volume became pretty weak, and the momentum wasn't there to break past this 144.50 level. So for me, I bought puts right here, which is betting for the stock to go down. So I bought in at this high a day, and I rode this trend down all the way to the low a day. And I made like I can't remember what my profit. I think it was only like a 20 or 30% profit, and that's because I did a week expiration, which we'll get into that as well. And you can see we got up to this level again. We didn't get all the way there, but we rejected off of this high once again, and we fell back down to the lower day, and we ended up closing in this area of the lower day. Next, we got FOMO. FOMO is more of a psychological thing, which is fear of missing out. Um, FOMO can cause you to go red on trades due to you jumping in the trade too early because you feel like it's gonna go up, or you're getting out too early because you feel like it's gonna reverse, or just whatever it is. But FOMO is something you don't want to have when you're trading, because it can lead to red days. Then we have zero DTE. So zero DTE is 0 days till expiration. It could also be one DTE, two DTE, three DTE, and so on. That's just how many days you have until that contract expires. So if I'm trading Amazon on a Friday, I could either do zero DTE contracts, or I could do next week contracts. If I do zero DTE contracts, it's more higher risk. They move a lot more towards the upside and the downside, but they expire that day. Um, like I said, I'll go more in detail with zero DTE or the days till expiration whenever we get over to the topic of Greeks. Then we have risk management. Risk management is one of the biggest things when it comes to trading, because this kind of dictates your trades. You could have the best levels when it comes to trading, but if your risk management is poor, you can still go red on that trade and lose a lot of money. You could also have the worst levels, but if you have good risk management, you could still profit on trades and become a profitable trader with just using risk management. So, like I said, those are some of the key terms and lingos that are used in trading. I'll make more in-depth videos as I go on with some things, but I just wanted to get y'all aware of the general basics and terminology that you might hear when it comes to trading.